Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
David Kelly is a jewel. He writes incredibly informed work. He did this for years at Putnam, now holds court at JPMorgan. We're thrilled he could get our holiday week here started. Strong. David, you start with, I love this, the Red River of the North, up in the Dakotas and Manitoba, up to Lake Winnipeg. And you're talking about the crazy river system of our North and Canada as well. Why is it like the stock market?
Well, the key about that particular river is it flows from south to north, which is actually very unusual in America for a big river. But that's actually a really big problem in the spring, because what happens is when the ice thaws, it all thaws in the south first, it all floods in, but the water can all flood into the river. It's just got nowhere to come out. And so it inundates, Grand Forks and Winnipeg, and all these poor cities just get flooded because there's no way for the water to get out. And the reason that's relevant to the stock market is we've been looking at, it's a tortoise of an economy, sort of, crawling, just staggering to the end of the year here. But we've had a hair of a market for a third consecutive year. Why is the market so strong when the economy is meh? And I think part of the reason is because there are institutional things within our market, things like stock buybacks, embedded capital gains, money flowing into defined contribution plans. All of this is funneling money into the equity market, and it's hard to get it out because of capital gains tax, and that's pushing money into giving us a really strong stock market in what's an okay economy, but it's nothing to write home about.
So, David, we had, as you mentioned, a really strong 2025 in terms of S&P and NASDAQ. Fixed income gave you high single-digit returns here.
Yeah.
What's the setup for 2026?
Well, I think the economy itself should be okay. I think it's going to be strong in the first half because of income tax refunds. So I think we will see a pickup in growth in the first half of the year, and then it's going to fade because we really are short of workers. For the market, we still probably need to see a shock to cause a big correction here. Eventually we will have some shock. Valuations are very high. But I think a base case is the equity market keeps on moving up. It probably broadens out a bit beyond the Mag 7 and it continues sort of broadening out to other sectors. But for investors, the real thing is, how much risk are you carrying? Because these are expensive stocks at this point. And I think really the resolution for 2026 is rebalance, because whatever happens to returns, the risk level is pretty high here.
Are the earnings that we see out there, the earnings in 2025 have been really, really strong here.
Yeah.
Are they strong enough as you look forward to kind of support this market?
Yeah, I think they should be. It's a, as I said, it's a moderately growing economy. So long as we avoid recession, one of the things that I'm seeing is a fair amount of weakness in wages. There aren't many available workers, but workers still can't get a pay increase. And meanwhile, companies are installing AI. Now, I don't know if that's making people more productive or not, but they say it's making them more productive. And so productivity numbers are going up because you've got fewer workers and producing more output. And that helps corporate profits too. So overall, I think the profit picture is pretty good. I think the rate picture is pretty stable, and that should support the stock market, barring some shock. But of course, there's always a potential for a shock.
We start strong on Monday. David Kelly with us for an extended conversation. He drives JPMorgan Asset Management with all of their strategy. David, one of my great insights, and folks, on my last 2 days of the year here, I'm really going to look back here. One of the great insights this year was Nancy Lazar, who David and I know for years with Ed Hyman. Nancy's up in Minnesota with Piper Jeffrey, and David, she just said, look, it's an economy where there's an odd job creation. You led on this 2 years ago. You're the one that said, get used to non-farm payrolls under 100,000. Yeah. Do you adjust like Jerome Powell? And are you giving me a real 3-month moving average now that's a negative statistic of payroll growth?
It's very close. I think we're talking about somewhere in the range of minus 50 to plus 50 is the trend rate. It might pick up a little early next year, but we're out of workers. We don't have good immigration data at all. The government stopped producing a lot of data that we need in order to figure out exactly what's going on with the growth in the working age population. But as far as I can tell, it's shrinking. And it's very hard to grow jobs when you're shrinking the working age population. But that actually has a feedback loop in the overall economy. You know, I don't know if you remember Say's law from your economic theories classes, but the idea that supply creates its own demand. If you pull back on the number of workers enough, and you don't open a restaurant because, hey, you couldn't staff the restaurant, so those jobs don't get created. You know, the meals don't get served, the houses don't get built for the people who aren't around to live in them. So the lack of labor supply is slowing the economy in itself. Right.
Say's law, Paul, at Trinity College is they open the Guinness brewery.
Yep.
And if they manufacture the Guinness, it somehow gets consumed. That's Say's law out of David Kelly's Ireland. I look, David, at the job economy, and I look at the worry out there, and to me, it becomes a political monetary policy. Can economists ignore a negative non-farm payroll trend?
I think if it continued into the first 6 months of next year, then I think the Fed would ease earlier. But I think we'll see a little pickup, as I said, because of income tax refunds. I think we'll see a pickup in growth, and I think that will stench the bleeding for a while. But then, you know, maybe later next year we do get rate cuts. But I want to make it clear: rate cuts won't fix anything here. The problems that this economy faces have got nothing to do with interest rates, or interest rates being too high anyway. So yes, it may force the Federal Reserve into cutting more aggressively later next year if we don't sort of put some more artificial stimulus into the economy, which we may well do.
David, at JPMorgan Asset Management, how do you guys think about alternative investments?
Mm-hmm. We think a lot about them. We're very conscious of the fact, you know, you're just talking about how good a year it's been for the stock market, and the bond market is giving you positive returns despite a fair amount of inflation. That means that a sort of 60-40 stock bond portfolio is pretty expensive. And people really need to diversify and reduce risk. But one of the key ways they can do that is investing in alternatives, things like infrastructure, transportation, real estate, also, you know, private equity and private credit. But you've got to know who's managing that money. But we definitely believe that all investors need to think about having some alternatives in their portfolio beyond the public markets, because the public markets do have a certain amount of risk. And by the way, there's also a lot of opportunity in private markets. The companies don't want to go public. And so a lot of the explosion of ideas around technology and AI and biotech and so forth, they're all occurring in the private market space. So you really want to be able to access some of that. So yeah, I think it's beyond time for people when people can just afford to ignore alternatives. I think people really need to think about their alternatives as they go into 2026.
So David, I mean, I can sit here in a 2-year treasury and get, 3.5%. That's a nice coupon relative to the last 10 or 15 years. Is that good enough in the fixed income space, or should I be taking some credit risk here?
I wouldn't take too much credit risk. I think I'd want to have maybe a little bit more duration than that, but not much. I don't think there's much money to be made in fixed income, but I think that it does help stabilize a portfolio. So I wouldn't be underweight fixed income. I wouldn't take much credit risk because credit spreads are really tight. And if we do have a recession, then these credit spreads are going to blow out, and you're going to get hurt. So I just don't think you're getting paid for taking risk in the bond market.
The melting ice, to your analog of the Dakotas and up to Winnipeg, the melting ice is the yield on money market funds. You got some people, they can do the math over there, you know. I mean, Feroli, Kasman, Santos, the rest of them. David Kelly, what's the math of when the dam breaks on money market funds? What's the yield or the ice melts?
I don't think that what usually happens is as those rates come down, you think a whole pile of money would come out of money market funds. But what happens is people get more and more scared that something is seriously going wrong here. It depends. If we have a recession, I would expect money to pile out of the money market funds and go into the bond market. But if it's sort of a recession plus inflation threat because we're going to get more stimulus in an economy that's supply constrained, if it's that kind of story, 2022 all over again, I think the money will sit in money market funds even if the Fed gets strong-armed into pushing rates down, because people will be genuinely scared of long-term assets.
So, David, in the equity markets, the U.S. equity markets, the last 2 or 3 years, really, it's kind of been an AI trade, a Mag 7, all that kind of stuff here. folks that have been waiting for a broadening out, they've been waiting a long time here. Is 2026 a year where maybe we can get some broadening out?
It could be. I mean, markets can remain irrational longer than you can remain solvent, as somebody said many, many years ago. So it could broaden out. I think if we have a big correction or a bear market, it will broaden out, because we know that the epicenter of any bear market is going to be the area of greatest speculation before it occurred. So I think there's a good chance it'll broaden out at some stage here. But the other thing to think about is, when you look at these mammoth companies who are pouring money into their version of AI, they're all making the same bet. And they've all got these sort of quasi-monopolistic profits, which are funneling into an enormous amount of spending on data centers and chips to be the AI superpower. But they can't all be AI superpowers. So even within the Mag 7, there's a lot of risk there that they're all chasing after a goal, a brass ring that not all of them cannot achieve, and maybe none of them can achieve if China gets there first.
David, trees to the sky. Paul asked about earnings as well. 4 years, double-digit return. Yeah. It's happened I think 3 times since the Irish kicked the English out of David Kelly's Ireland. David, come on. I mean, there's a point where this breaks. What should our listeners and viewers study and observe to try to get a bit out front of when the market breaks?
Well, I think the first thing is look at that AI trade and look at some of the big players there. Is it going to come a point where people get skittish about some of the players in this space, whether they will be the winners? Because if it looks like you're not going to be the winner, then should you be putting all this money into it? And if you shouldn't, then what's your business model looking like? So I think that's one area of vulnerability. And then also, frankly, keep an eye on the politics of all of this. I mean, I'm very worried that we're going to try to do tariff rebate checks, which will just, if we pour more consumer stimulus into the economy before the midterm elections when we're supply constrained, we're going to reignite inflation. Right. That is certainly a fear. If our political system is not capable of dealing with the moment with some sort of sobriety, we do have a problem. I think that's the other thing people should keep an eye on. But more generally, look, we don't know where the next shock is going to come from. That's why you go into next year with some sort of balance. So, regardless of how you try and figure out the risks, look at your portfolio. Is that more risk than you should be taking? If it is, how can you, in a tax efficient way, get to more balance? And I think that's a real question for 2026.
David, thank you so much. It's a great way to start this holiday week. David Kelly with us. He is forever of JPMorgan. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We have the perfect guest after the certitude, whatever you think of the politics and all that, the certitude of Stephen Myron. Here, George Bory with us right now, who writes in a wonderfully measured approach to fixed income for Allspring Global Investments. He's Chief Investment Strategist, Fixed Income at the firm. George, I look at the forget about the theory. The certitude of Stephen Myron is breathtaking. Would anybody, if I mourn the day we lost Marty Feldstein as PhD advisor. If Professor Feldstein was sitting here, I'd be saying, are you kidding me? Professor, did you teach him this certitude? When you hear that certitude of opinion from a legit economist, how do you react?
I think there were 2 very strong messages in what he had to say. And the first is really, the easing bias is very much in place. There's a mixed view, but as he said, Chairman Powell's done a good job of wrangling the committee. The committee itself seems biased to continue down this easing path until data says otherwise. And then secondly, they seem committed to wanting to extend the cycle and trying to engineer not just a soft landing, but ongoing expansion. Right. And I thought what was really interesting is talking about that balance between supply and demand, very economic driven, basic principles. But if both are expanding at the same time, that really is the ultimate cycle extension, and it sounds as if the Fed is committed to doing that.
I was going back and forth with David Gurr before this. We're commercial-free folks at the top of the hour. Let me get one more in, Paul. So, George Bory, I look at this, and I go, okay, we're going to get a Myron vector to lower interest rates. I'm not sure it benefits the have-nots. Let's say it benefits the haves in the financialization of America. You're living this every day.
Yeah.
If you get a Myron vector, it's like boom, right?
I think there are three big factors that are going to drive through markets next year, very much bond market focused. Number one, cash is on the move. If the Fed is biased to ease, then that $8 trillion in money markets and in short-term deposits are going to be looking for other places to go. And in a world where inflation still remains up around that 3% level, the free trade, the easy trade is over. You're going to need to move that cash into something else. And so moving out into short duration bonds seem likely. The second is the curve. The curve itself kind of came down a little bit. Yields came down a little bit this year. It sounds as if we're going to see more of a twist next year. That front end coming down, the long end could actually start going up again. And so we think that actually is a really big theme that bond investors are going to contend with. And then the last, you talk about haves and have-nots. If we look at the corporate side of the economy, event risk, defaults, M&A, the AI build out, the drawdown of cash in the system to sort of spend money on things has kind of a mixed impact on credit markets. And credit markets themselves are seeing a pretty big kind of increase in dispersion, and would suggest that we're in the later stages of a credit cycle, not the end, but very much the later phase. And so these three big themes are going to be what bond investors and any investor really is going to have to contend with. Now, navigating that's going to require some maneuverability in your portfolio. If you do it well, for bond investors, mid to high single digit returns is sort of what you're shooting for. That's kind of the best we can hope for. But it's not going to just come to you. The beta trade, if you will, happened in 25. Next year, 26, you're going to have to move it around a little to actually achieve those kind of returns.
How about if some of that cash moves into municipal debt, particularly for those in high tax jurisdictions?
Yeah, munis still look very attractive relative to other bonds. Yields have not moved down as much as we've seen in the taxable side of the market. And so in the world of munis, where you've got the benefit of high ratings, you've got balanced budgets at the state levels, and you still have very good income streams coming through, we think there's really good value in munis, and it's a nice way to kind of add to that portfolio. The tax advantage is huge for the haves, and so we'll see good demand over the course of the year, and they're going to be very susceptible to those three basic themes of moving out of cash, twisting curve, growing event risk.
So it's not really your act, but let's ask, what's a single point 10-year yield for you 12 months out?
I think 12 months, we're probably right around 4%.
Fan distribution, 4%.
Yeah,
we're
down a little.
So what does a 30-year mortgage do? If we have curve steepening, is the surprise here it doesn't come in?
It doesn't come down much because the 30-year could be back up above 5. And so the twist is actually very much around that 10-year part of the curve. Front end comes down about 25 basis points. Long end goes up a little. Mortgages don't come down that much.
We turn to surveillance real estate correspondent Paul Sweeney here. That's grim.
That is grim, because I think if you talk to some real estate agents, they say they need to see something with a 5 handle to get people to maybe leave their homes and put stuff up for sale.
I mean, Myron's got the trend right here. We got to go here in like 1 minute. But George, if sort of Myron happens and the Fed cuts rates, I'm sorry, what does it do to a 60-40 portfolio? It's like, it's the edge of nirvana. It's like, what remember when your father made the charcoal fire and you took the gas thing and squeezed the gas on it?
What could go
Don't do that. Isn't that what we're talking about?
It certainly should heat things up. Then that's for certain. And so, that's why we think this kind of late cycle, sort of phenomena is upon us. It's why, intermediate, short part of the curve, and you're going to be forced out of cash. That is the accelerator. That's exactly what we're talking about.
For all of us, thank you so much for your commitment to the Bloomberg surveillance, George. coverage, Bory.
Thank you very much.
Really, really wonderful. He's with Allspring Investments. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's move on to Michael Purves and look at the sanity here. Michael, you and I have seen, Paul's never seen it like this, the stupid season in M&A. You've got really a lot of experience in this. Michael Purves, how does the certitude of transactions and combinations, how does it end?
Well, I think for the near term in this context, maybe being 2026, I think we should expect more M&A. And one of the reasons why I say that is because on one hand, you're seeing reasonably strong equity markets and stability in rates. And, you look at Treasury volatility, that's much lower. Rates may not be as low as some would like, but the rate volatility is lower. It sets a better platform. But I think the other sort of overarching theme here is that, we have this K-shaped economy, but I also think there's sort of a K-shaped stock market dynamic as well. And we've talked a little bit about this in the past, Tom, but what I mean by that is that with AI and with reorienting supply chains globally, scale matters, right? Larger companies are able to sort of manage through these transitions better than smaller ones in many cases there. So I think you're going to keep seeing smaller, medium-sized companies merging to get scale so that they can survive and thrive in this new era.
And we're seeing that just with the news that Tom and I were discussing just a moment ago with Paramount and Warner Brothers Discovery. Michael, talk to us about kind of the risk outlook for 2026. Again, the stocks and bonds and commodities were just ripping in 2025. How do we set up for 2026?
Well, look, I think broadly speaking, the macro, we have a good sort of macro setup for risk appetite, right? In terms of, we've got sort of warm, maybe hot monetary policy. We've got some warmth in fiscal policy concurrently, here on top of reasonably strong earnings growth, on top of a not perfect, but decent enough economy. There, but I think there's one big risk here for certainly just talking more about equities here than rates. But if you look at the Mag 6 or the Mag 7, that if you look at the outperformance over the last several years, that has basically matched this wonderful performance in the stock market, in the U.S. stock market here. But right now, these big companies, particularly the big CapEx spenders here, which is Meta, Amazon, Google, and Microsoft, those companies are going through a valuation transition here where, if you look at the price earnings to growth ratio, things look great, very compelling. Price earnings to growth ratio is at 0.8 right now, low, very, very low level. But their free cash flow yields are at record lows, right? And their free cash flow yields are at record lows, not because earnings are bad or EBITDA is going to be bad, but simply because of the CapEx spend. So what I'm looking for, Paul, in 2026 is that if there's indications that the return on invested capital from this CapEx spend is not there, then you're going to have a lot of narratives rewritten, and you're also going to have valuations reset lower for these key stocks there. And that, to me, it's like a micro risk is almost a macro risk, because we're talking about, $1 trillion in spend from just 4 companies over the next 24 months. So that really flows through to everything.
Michael Purves with us for a good conversation this morning to get set for 2026. We welcome all of you across the nation, the way you listen to us. Good morning, 99.1 FM, Nathan Hager Radio in Washington, 92.9 FM in Boston, and Bloomberg 1130 in New York. But around the world on YouTube, subscribe to Bloomberg Podcasts. Make it a habit for next year. When you can. It's a great live chat there, but most importantly, people watch and people listen to YouTube while it's on. That's been a huge success for us this year. Paul Sweeney with Michael Purves.
Michael, talk to us about kind of the earnings environment out there. We've had really, really strong earnings in 2025, particularly the last couple of quarters. How do you think about the earnings growth for 2026, is that enough to support this market?
Paul, it's a tricky one, I think. If I look at the S&P as sort of like a holding company with two divisions in it, one of which being the big tech monsters and then the everything else at a very simplistic level. So you can look at the SPX equal weight index as sort of a proxy for everything but the Mag 7. And if you look at that, earnings growth year over year is sort of 4%. Can it beat that? Well, it will need to have some decent nominal GDP to go along with that. That I expect. I think the harder one is whether the margins will really be there to support that. Embedded in that 4% earnings growth. That's not my number. That's Bloomberg's bottom-up consensus estimates. Our record earning and operating margins, which are to a degree reflect the successful adoption of AI and productivity gains within these companies there. So I think, it's not a big number. They have beaten that number in the past, but it's also, if we run into sort of more of a stagflationary dynamic and that starts really hitting some parts of the economy, the bottom end consumer are already seeing weakness there, then I think the SPX equal weight is not very compelling. And by the way, we were talking about price earnings to growth ratios. If you look at the price earnings to growth ratio for the SPX equal weight or for a lot of value and cyclical indices in the U.S. stock market, those are very high there. So they really need to outperform on earnings just to justify the current valuations there.
What's your appetite for the timing of the market? I mean, you've been so good about, look, you got to be in the market to play. You've been legendary on that. But is timing efficacious now?
Look, I mean, technicals are always really important here. Look, my very short-term trading call is I think we're going to have a nice sort of Santa drift up higher into year end here, probably led by large tech shares. That said, if you zoom out and you look at long-term technical charts, you're looking at us trading at high valuations at the very high end of a sort of a 15-year channel coming out of the great financial crisis there. And typically there's some significant volatility in the following year that follows that. If you're at the top end of the channel there, momentum signals are a little mixed right now, depending on what you're looking at. Generally, I think they're pretty constructive, but not as constructive as they are for gold and silver.
Paul, for Global Wall Street, I think I got to interrupt and do this. This is reporting off our Tokyo desk on Japan. This is with the finance minister, Satsuki Katayama, in conversation with Bloomberg. This is reporting, and Bloomberg reports the finance minister says Japan can take action as set out in U.S.-Japan joint accord. Japan has a free hand for bold action in FX market if needed. This is about this strange thing called intervention, and will they intervene to drive yen stronger? Carl Weinberg, among others at High Frequency Economics, Paul, has an absolutely blistering no doubt that this is not going to work out well. Intervention is not going to be efficacious for Japan.
Japan 10-year yields surged to highest since 1999, according to Bloomberg reporting there. So that gets your attention there. Michael, talk to us about the fixed income opportunities in 2026. 2025 was a good year. I mean, high single-digit returns. I mean, people actually want to hang out with fixed income people these days. What do you think about next year?
Well, just to pick up on this Japanese yield question, I think it's important. What's going on with the yen is sort of what we had in the first half with the dollar, which is that you saw currencies really decouple from their respective real rate differentials. And I think that's important there. And I do think that you can sort of feel it and see it a little bit in the back end of the Treasury curve that the yen, the movements in JGBs and Japanese yields are being exported a little bit to our Treasury market here, there. And if you look at the sort of the spread in rate differentials, you can see that same echo in the R1030 curve here there. So I feel like that's sort of a new factor that we need to consider here. That's not, sort of an unhealthy type of curve steepening here. All that said, I think what I'm predicting is sort of a pretty boring year in rates for all the drama about the Fed and inflation and all that kind of stuff, all of which are very warranted discussions and debates. I'm expecting the Treasury vol to get lower. I'm expecting, 1 to 2 cuts. I'm expecting a fair amount of dissent within the Fed, which I think actually suppresses Treasury vol. And I think we should see some curve steepening and if the Fed does cut more than perhaps it should, you're going to see that echoed. Just, the more dovish you get, the more term premium you get on the back end there. But I think it all sort of ends up keeping the 10-year in a range.
I got to be quick here, Michael. We got to go to breaking news. The Detroit Lions lost. But, Michael, I'm looking at curve steepening. It's clearly nonlinear. How close are we to where curve steepening really matters?
Well, look, I in terms of these existential questions as to when, the 10-year is going to spiral out of control and hit 6%, those are always tail risks to consider. I think right now, it would be such a problem for every facet of the U.S. economy and market and political headaches that I sort of think that there'll be something done in that respect. But that may not necessarily be the right way. But I do think one of the things to consider next year is if we start seeing an unhealthy spiraling of term premium, does the Fed do something on the back end with its balance sheet?
Michael,
I think that's something you have to consider. Yeah.
Michael, thank you so much. He goes up. He's on Squam Lake, even if it's like 50 below zero.
Yep. Okay.
He sees Santa first.
Yep.
But Michael Purves with Tallbacken, thank you so much. Greatly appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
With our newspapers, Lisa Mateo.
Okay, did either of you go to the movies over the weekend? No? Didn't see the Avatar?
No.
Oh, my goodness. Okay.
A bunch of people did, though.
A lot of people did.
Yeah.
They did. And that's the thing. Walt Disney's Avatar, Fire and Ash, highest grossing film at the box office, 88 million tickets, U.S. and Canada. They were a little bit lower than expected. Even Disney was expecting about 90 million or so. It did well internationally, though. That was a big thing.
Particularly in China.
Yeah, exactly.
Yep.
Particularly in China.
Yep.
And where does it stand domestically? So if you compare the other Avatar films, so it surpassed the first Avatar film that was back in 2009. It fell behind the recent sequel, Avatar: The Way of Water, in 2022. But I mean, this is going to keep making money. I mean, the kids are going to be off, families are off, and it's going to keep pulling in some money. I mean, Disney has been pretty good. Lilo and Stitch, Zootopia 2, they both generated more than $1 billion at the global box office.
The budget's $400 million.
It's a lot.
100 used to be like a huge deal.
Yep.
What do you spend $400 million on to make a 2-hour movie?
CGI, computer-generated images, all that kind of stuff. But I tell you, again, the real big story here is China is reopening its market to Western films, and that's big.
Zootopia, I think, did well there as well.
Yeah, so that's
right?
because it was closed, kind of after the pandemic for many, many years. So that's good news for Hollywood.
I could see Paul at Netflix. Sure. He could do like a daily squawk for Netflix.
Yeah,
nice.
Absolutely.
See it. What do you got next?
Okay. Online shopping, right? It's been hurting foot traffic in stores. So what a lot of retailers are doing, and the Wall Street Journal has this about FAO Schwartz, is that they're doing a lot of in-store experiences to get the customers back. So like personal shopping tours, customized toys. They're trying to do things. I'll give you an example. Okay. So people are paying $100 for a private shopping tour. And then those families go on to spend, hundreds of more dollars on the toys. Then for $250, you can get a longer tour session. You can get drinks at the VIP suite. You can get shipping arranged for your purchases. And are you ready for the top tier? Okay. $3,750 for that. You can get a tour for the family. Someone is dressed as a toy soldier. It's after the store is closed, so you have the whole thing to yourself. There's dinner, there's a magician, there's everything like that. So they're basically appealing to like the higher end, customer that are doing this. But it's a lot of competition because
is FAO Schwartz store? It used to be 59th and 5th.
I'm not sure exactly, but they closed.
That
yes.
one. I don't know if they reopened
now they
something.
Reopened, yes.
Okay.
So now they have reopened.
Can I there was a certain value to the eventness of the Sears catalog on the living room floor, and you'd skip the front end with clothes for women, and you'd go to the back end where there were Silvertone guitars and You know, I mean, it was like, you have
The
no
JCPenney catalog.
You have no idea what I'm talking about. The Sears catalog was like
Sears, yeah.
was like 3 inches thick.
Yep.
Big thick thing, and then you just lined it up for your parents. That was the event.
Yep.
I know.
There you go.
They used to have the Toys R Us one too. I know. It was the thing.
And now it's $3,000
And
to
now, the in-store experience.
Next, save
it's
us with
about
one
the
quick here.
experience.
One quick here.
Oh, this is a doozy. Jake Paul went down on Netflix. Yes,
You didn't watch this, did you?
I totally watched it on Friday.
no.
He was beat by Anthony Joshua, former heavyweight champ. All right, so he's a little bit younger. Jake Paul's 28. Joshua was 36. But Joshua was also 6'6". He hit the scale at 243. Jake Paul, I didn't realize he is 6'1", but he weighed about 216. But it was a 6th round. Knocked him out. I think he even broke his jaw. Jake Paul was posting about that too. But he earned nearly $100 million from losing the match. But it just goes to show you sports on Netflix. Like this is another big thing because you had the Jake Paul Mike Tyson fight, and now this one.
Yep.
So a lot of people are tuned in. We don't have the numbers yet, but a lot of people.
Nice.
Okay.
Netflix is just riding high.
I went below 59th Street
Wow.
this week. New York police
And?
greeted me. I just saw some of the Christmas cheer.
Yeah.
The newspapers, Lisa Mateo, thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.